I know Sandy's welcomed you. I'm Mark Zupan, Dean of the Simon School of Business. Wanted to add an official welcome from our end as well, and thank J.P. Morgan Chase for being our co-sponsor for this event. This is probably the most eagerly awaited forecast, given the times we're living through, and we have the great pleasure and honor to have one of the top monetary economists in the world with us today to offer his insights on where the economy is, where it's headed. None other than Charlie Plosser, who has been the longtime co-editor of the Journal of Monetary Economics, the leading monetary economics journal that has had a home at the University of Rochester's Simon School of Business. Also a longtime faculty member at the Simon School and former dean, and now the current president of the Philly Fed. So Charlie, we're delighted you're here.
Thank you. Well, thank you, Mark. I'm delighted to be here again. Delighted to see so many old friends and familiar faces and be back in Rochester, and almost forgotten what the snow was like, but this morning I woke up and there it was. You know, I was told this is the 30th annual of these economic seminars that we've conducted here. I think I've been at all 30 of them. And I'm really impressed that you still come back to here. I feel like an old loaf of bread that's a little stale and crusty around the edges, right? And the older I get, the more crusty I feel sometimes, and certainly in this environment, feeling crusty is not all that unusual, is it? But I left to Rochester just over 2 years ago in August of 2006, and at that time, the housing market had been slowing. There's no question about that. But I don't think anyone imagined the kind of economic turmoil that has followed since then would have predicted that. Now, to my way of thinking, there's no one cause of this turmoil we're experiencing. Rather, I think we need to look at several factors, conditions which I sort of describe as akin to the perfect storm. That perfect storm, in some ways, although the analogy is not perfect, led to a financial tsunami we've experienced now for more than a year. That tidal wave has roiled the economy. It began with a sustained decline in housing prices following a decade-long boom. Yet, it took more than just a decline in housing or a reversal in the housing market. More than that was needed to cause the turmoil that we've seen. We had other problems. Innovations in lending that made subprime mortgages possible in the 1990s succeeded in expanding home ownership to millions of families, and these products proved both profitable and successful through 2006. This success, however, led to lending terms that were highly dependent on rising house values. The prospect of continued increase in house prices fostered many lenders to offer products with little or no down payment, even to the riskiest of borrowers, and at times at very low teaser rates. Many borrowers, in fact, were speculators who expected to ride the wave of higher home values until they resold. Others expected to refinance their mortgages when the teaser rates expired, when their houses were worth more. Yet as the housing prices continued to decline, many homeowners and investors found themselves unwilling or unable to meet their mortgage payments. The economy and the financial system may well have been able to absorb even that downturn, if not for other contributing factors. Mortgage originators often sold off these risky loans as mortgage-backed securities. Those investors then often broke those securities up into tranches, as they say, that had different credit ratings and resold pieces of these mortgage-backed securities to different investors. What's more, those investors often who own these securities bought insurance, which amounted to credit default swaps. These credit default swaps turned out to be much riskier than many issuers had anticipated. These new products, however, were also very complex and lacked transparency. They also resulted in even more interconnections among financial institutions, allowing the problems in the U.S. housing market to spread to a wide array of financial institutions. As house prices began to fall and mortgage delinquencies and defaults rose, market participants grew uncertain about how to value the various complex financial instruments and which firms were exposed to how much of those securities and how much they were worth. As a result, they became very risk averse and reduced their exposures by curtailing lending. This has also led to higher credit spreads or risk premiums on the securities of financial firms that may be at risk. It also has led to rating agency downgrades and sharp declines in stock values, which ultimately disrupt financial markets and have created ever-widening credit crises. Now, even non-financial firms are finding it difficult to obtain short-term credit and to meet the continuing operational needs and capital investments. Today, in the wake of that financial tsunami, I'd like to offer some perspective and outlook for the economy in the coming quarters and make some observations about the Fed's actions and a little bit about regulatory reform going forward. So let me start with the economic outlook. The financial turmoil of the last year has taken its toll on the economy, and it has slowed significantly since early summer. Housing starts, permits continued to fall in October, and other recently monthly data, whether it be auto sales, consumer spending, or industrial production, have all pointed to a significant weakening in the economy. This month, the Philadelphia Fed's Business Outlook Survey of manufacturing activity recorded its lowest numbers in 18 years. Neither consumers nor businesses have much confidence in the prospects for the economy in the near term. Even exports are no longer the bright spot they've been over the last 2 years. The stress in financial markets has now become global, undermining economic growth around the world and among our trading partners, and consequently the prospect of a global slowdown further contributes to a weaker outlook here in the United States. The latest report on GDP growth indicated that a moderate contraction occurred in the third quarter. I anticipate we'll see a much sharper contraction in the fourth quarter of this year. And as such, it will likely put real GDP growth for 2008 on a fourth quarter to fourth quarter basis somewhat less than 0.5% for the year. Growth in the first half of 2009 is also likely to be fairly weak. But we should begin to see some improvement in the second half of the year. Even so, overall growth for 2009 is likely to be less than 2%. With relatively weak performance, overall performance over the next several quarters, unemployment rates are likely to continue to rise. Will probably rise above 7% in the coming year before sometime probably late in 2009 they begin to moderate somewhat. Unemployment rates, though, tend to rise much faster than they tend to fall, so the tapering off will be rather slow. During 2009, the housing sector should finally bottom, and the actions taken by the Federal Reserve and the Treasury will gradually help financial markets return to some semblance of normalcy. So as I indicated earlier, the economy should begin to start picking up somewhat in the second half of next year with a gradual return to trend growth sometime in 2010 and 2011. But I should caution. Many forecasters, including myself, have been anticipating an improvement in housing for some time and seem to be continually wrong. What's more, financial disruptions continue to flare up in sudden, unexpected bursts. So more than the unusual amount of uncertainty clearly surrounds this forecast. Those of you who have heard me speak here before, I've often told this audience that we must keep in mind that forecasting can be a humbling experience, even in the best of times. And in these times, a great deal of humility is called for. As for inflation, the decline in energy and commodity prices in recent months has reduced my concerns about rising inflationary expectations, at least in the near term. This is good news, but it does not mean the Fed should be complacent or abandon its responsibilities to maintain price stability. The current monetary policy and the Fed's extraordinary lending facilities created to address this crisis have injected large amounts of liquidity into the economy. We will need to begin withdrawing that liquidity when financial markets begin to stabilize, or we will run the risk of renewed inflationary pressures down the road. At a time of great concern about financial turmoil, we should keep in mind that instability in the general level of prices, whether it be inflation or deflation, is itself a significant source of financial instability. Federal Reserve officials, myself included, have many times spoken of the importance of keeping inflation expectations well anchored. when the public's inflation expectations begin to rise, that in and of itself can help contribute to more or actual inflation. It is therefore extremely important for the Fed to maintain its credibility to keep inflation low and stable when large relative price movements, like we've seen in food and energy, lead to large increases in headline consumer prices. But it is just as important that inflation expectations remain well anchored in the face of falling energy prices and commodity prices. Significant declines in gasoline and fuel oil prices, for example, have recently led to declines, that is negative numbers, for inflation in headline consumer price inflation. Now this has prompted some commentators to suggest that the U.S. is facing a threat of sustained deflation, much as we did during the Great Depression or as Japan faced for almost a decade. I do not believe that's a serious threat. Although the recent dramatic declines in energy prices have led to declines in the monthly headline CPI, it still increased at 3.7% over the last 12 months, and core CPI has increased at 2.3%. So we are not close to deflation right now of any sustained magnitude. The recent declines, in my view, simply reflect the mirror image of the increases we saw earlier in the year. As long as inflation expectations remain well anchored, these declines in energy prices are not likely to lead to sustained deflation any more than their previous increases were likely to lead to sustained inflation. But to help anchor expectations, the Fed must credibly commit to preventing sustained deflation from becoming widely anticipated, just as we must prevent sustained inflation from becoming widely anticipated. I have long argued in many speeches of this group and for many years that monetary policy would benefit from establishing a clear and explicit inflation target as a way of signaling its commitment to keep inflation low and stable. Such an inflation target would be just as valuable in preventing expectations of deflation as it is in preventing expectations of inflation. Now, to address the financial crisis and its impact on the economy, the Fed has acted on multiple fronts. Since September 2007, we have reduced the federal funds rate target by 425 basis points in response to a steadily deteriorating economy. As I've already indicated, this has added significant liquidity to the economy. While lowering the Fed funds rate seems like a fairly standard monetary policy response, the Fed also took historic actions to promote financial stability by expanding its role as lender of last resort. Starting last year, the Fed expanded its existing discount window operations and created what I call an alphabet soup of new lending facilities to help funding markets function more effectively. Some of these actions required the Fed to invoke a special provision of the Federal Reserve Act, referred to as Section 13.3, which gives the Fed the authority to lend to any individual, partnership, or corporation in, quote, unusual and exigent circumstances. And I'll let you decide how to define that. Prior to this crisis, the Fed only lent to depository financial institutions. That is, we would lend to banks, savings and loans, savings banks, and credit unions. And such lending was typically overnight in term. During the last 8 months, we have made loans to primary securities dealers, investment banks, a global insurance company, and most recently to industrial and financial companies that issue commercial paper. These lending arrangements have been for terms ranging from 90 days to as long as 10 years in the case of the financing provided Bear Stearns, providing for the Bear Stearns acquisition. Now, prior to this crisis, the Fed lending typically amounted to about 1% of our balance sheet. 1%. According to the latest data, Fed lending now accounts for almost or nearly 50% of our balance sheet. The most dramatic decisions, of course, were made jointly by the Federal Reserve and the Treasury. In particular, the decisions to provide funding to facilitate the acquisition of Bear Stearns by J.P. Morgan Chase, to lend to AIG, and not to commit funds to Lehman Brothers have raised fundamental questions about the role of the Fed in promoting financial stability. More generally, the necessity of taking these actions suggests that we need a new regulatory structure to better match the reality of our complex financial institutions. Now, the current financial crisis and the actions of the Fed and Treasury to address it are currently, as we speak, leading to a restructuring of the financial services industry. We are already seeing major investment banks become bank holding companies. Weaker financial institutions consolidate into healthier ones, and various types of non-bank financial firms substantially revising their business models. The financial turmoil and the resulting restructuring in the marketplace have prompted calls for the Fed to assume expanded responsibilities. Some envision the Fed's becoming the supervisor and regulator of a broad array of financial firms in order to ensure financial stability. Some want to expand the Fed's authority or give it a sweeping mandate to prevent systemic risk. Some want the Fed to lend to a wider range of financial institutions. Yet before we seek to expand dramatically the Fed's responsibilities, I believe it's important to recognize the limits to what a central bank can and should do. In general, we should avoid giving the Fed overly broad mandates or missions or goals that conflict with the one goal that is uniquely the responsibility of the central bank. And of course, that's price stability. As I noted earlier, instability in the general level of prices, whether in the form of inflation or deflation, is itself a significant source of financial instability. So we must make sure that in trying to cure one set of financial ills or instability, that we don't sow the seeds for the next one. Over the past 2 decades, economists have learned to conduct monetary policy more effectively by following 4 general principles. First principle is clarity. Policymakers should set clear and explicit objectives. These objectives must be realistic and feasible and not just somewhat desirable or some form of wishful thinking. Second, commitment. Policymakers must commit to conducting policy in a systematic way over time, even when it seems expedient to abandon it. The third principle is transparency. Policymakers must be as transparent as possible in communicating their policies and their actions to the public. And fourth and last is independence. Experience has shown that monetary policy yields better outcomes when it operates independently of fiscal and political influences. I believe these 4 principles broadly apply to other central bank roles as well, including our role as promoting financial stability. Indeed, we can think about how each of those principles should apply as we face challenges and changes in our role as a lender of last resort. Now, fortunately, the Fed has had to act as a lender of last resort relatively infrequently. That's good. The traditional goal of central bank lending has been to protect against systemic risks in the banking system. So central banks fulfill their role as lender of last resort by lending to solvent banks with liquidity problems to prevent problems in one bank from spilling over and causing failures in otherwise sound institutions. However, financial instruments in the market in which we are traded have become very complex and interconnected. We have found that the failure of a major counterparty, even a non-bank, has the potential to severely disrupt many other financial institutions, their customers, and other markets. The lack of transparency in some of these instruments and markets makes it more difficult for market participants to identify who is at risk and to what degree, increasing the systemic risk posed by such failures. In today's financial system, we must devise new and clearer objectives for central bank lending. If the goal is to protect the financial system from systemic risks, then we must clearly define that risk and articulate in advance the circumstances and terms under which we will lend and to whom. I believe we should concentrate on those financial markets that are critical to the functioning of the payment system, rather than focusing on individual firms. It would be desirable, in fact, to be in an environment where no firm was too big to fail or too interconnected to fail. Even so, we must be realistic and set objectives that are feasible. Central bank lending cannot prevent all types of financial instability. Indeed, the economy benefits from financial institutions and markets taking on and managing risk. That's what they do. That means inevitably that some firms will fail. As my friend, the economist Alan Meltzer has said, and I quote, Capitalism without failure is like religion without sin. It doesn't work, unquote. Our goal should not be to prevent every failure. Instead, our goal should be to lower the probability of a financial crisis and the costs imposed from any troubled financial institution's failure. Now, according to the second principle, policy should be systematic. This means that policymakers should avoid unnecessary volatility by committing to a mostly predictable response to events, even when it seems expedient to do otherwise. Uncertainty breeds volatility. I liken this to declaring the rules of the game in advance. If the rules are constantly changing during the game, players don't know what to do next. Outcomes become highly uncertain, and resources will be wasted in the process. During the past year, the Fed has taken steps to limit the systemic risks caused by the potential failure of several large financial institutions. These decisions were always made based on the risk to the financial markets, not to desire to preserve individual institutions. Yet the old rules of the game are out of date. The ability to deal with the potential failures of systemically important non-bank financial firms was limited. The Fed and Treasury had to improvise. As a consequence, we had no choice but to generate some uncertainty. We must correct that going forward. My third principle is transparency. And that stresses that policymakers should be clear and transparent in communicating their policy actions to the public. This is an important part of reducing uncertainty and, again, making the rules of the game clear. Clarifying the Fed's lending policy and the criteria that will be used in taking actions, as well as the criteria that will be used to determine when to close any special lending facility that we've created and when that's no longer needed. All of those things will help lower the cost of uncertainty during a financial crisis. Finally, independence. As we revisit our central bank lending policy, we must not overlook the importance of central bank independence. The record shows that central bank independence leads to more effective monetary policies around the world, and that principle is vital to our lending policies as well. To protect that independence, central bank lending policies should avoid straying into the realm of allocating credit across firms or sectors of the economy. That's best left to the marketplace. The perception that the Federal Reserve is in the business of allocating credit is sure to generate pressures on the Fed from all sorts of interest groups. In my view, if the government must intervene in allocating credit, it should be the responsibility of the fiscal authorities rather than the central bank. This division of labor, so to speak, will better ensure the Fed's ability and credibility to maintain price stability and promote economic growth. To sum up, this last year has been a challenging time for the U.S. economy and for policymakers, believe me. Nowhere did this crisis show up in the contract I signed to become president of the Philadelphia Fed. But the Fed is responding to this deteriorating economic outlook and the ongoing stresses in financial markets with a monetary policy and extraordinary actions to ensure financial stability. I expect economic growth will be weak over the next several quarters before improving later in 2009, as I said. Because of the financial crisis and the response by the Treasury and the Fed, the financial service industry is restructuring. When some normality returns to the markets, which it surely will, some type of regulatory reform will be needed. Some people may think that expanding the Federal Reserve's regulatory and supervisory authority would prevent the types of financial crises we have been experiencing this year. Yet I believe it's important to be realistic about such capabilities and recognize the limits of what a central bank can and should do. A modern financial system will never be immune to all financial stress. Setting expectations that the Fed or anyone else will surely be unable to fulfill would undermine our ability to achieve our primary monetary policy and financial stability objectives. The exact outcome of this regulatory reform is unknown at this point. However, as we work on reform, I believe we must strive to develop sound policies that obey the four principles I've discussed today. Clear and feasible objectives, a commitment to systematic policies, transparency, and a healthy respect for the independence of the central bank. Thank you very much.
Thank you, Charlie. Just to let you know that after Jim gets through, there'll be time for questions to ask both of them, so please be thinking of those. It's my great pleasure to introduce Jim Glassman. I've known Jim for many years, and Jim is the Managing Director and Senior Economist for J.P. Morgan Chase Bank. And in that role, he counsels the Chief Investment Officer of the bank, the government relations people, the investment bank, and the commercial bank. However, he's saying he's staying close to the commercial bank right now because given the problems on Wall Street, the investment bank and some of the others aren't making any money, and the commercial bank is the only one to stay with right now. So last year, as you probably know, he also, if you can read in the bio there, prior to coming to the bank, he worked with the Federal Reserve Board in D.C., and that he is widely sought after for commentary on all your political and news shows about what's happening in the economy. One of the things that we talked about, and as I mentioned when we opened up, is that, as he told me, he dodged a bullet last year and wasn't here. We had someone else, but he did say that he predicted all this, and he's got it all down. What he's going to do today is give you a little view of what to look for in '09. Jim?
Everything in my bones, which were shaped by years of mischief making and boarding school, tell me that I've got a phenomenal opportunity here in this forum with Charlie. Charlie has to wear a straitjacket. I don't. But I decided I better behave myself because I actually live in Charlie's Federal Reserve District. I'm right outside of Princeton. We're on the northern border. And I figure if I don't behave myself, the Fed will come after my house. Would you like my house? I know how to make it so you can take my house, actually. And I think a lot of folks have figured this out, by the way. Not hard to be late on a payment. Last night I was flipping through the channels board, and actually the History Channel's program on the sewage treatment plant was actually the most interesting program around. But I happened to flip to Greta's show. She had the fellow who wrote the piece on the front page of the Wall Street Journal today, who was saying, the MBER just told us we went into recession a year ago, December, and come April, this recession will be the longest of the modern ones, and we will be knocking on the door of the 1930s. My reaction to that was, you got to get a grip here. We just closed, by the way, the longest running consecutive string of employment gains in the last cycle. We've never had one like that. The test of what's going on here is not how long we've been going through the thing, but sort of what's behind it and how deep. Unemployment's 6.5% here. This is not like the 1930s, where we lost 25% of our GDP, unemployment got to 25%. We're just not going to see that. Thankfully, I know that ahead of time. Now, the title page here there's a subliminal message buried behind that I'm not going to talk about unless you want to talk about it. And it's showing you the difference between LIBOR rates and the Fed's, and what the market thinks the Fed is going to do. And in my mind, it kind of symbolizes an awful lot of what's going on here in the financial markets. It symbolizes fear and panic. It tells you, and the Fed, this is happening in the Fed's own backyard. When you see LIBOR rates widening relative to the Fed funds rate, it's not, what we're learning is that it's not really a shortage of liquidity. What it is a fear of counterparty risk, a fear of lending to somebody who you think may go down. And that's why the Fed has been struggling so much with all these programs they've got. You'll notice, if you care, for all the injection of liquidity, what's happening is excess reserves have exploded. which means people aren't willing to make use of that money. They're not lending it. So to me, it symbolizes a lot of how to think about what's going on in the financial markets. And it's also a reminder, fears obviously can become self-fulfilling, and you need to respect that. But this is something that can pass quickly when you sense that the dangers are behind us. Now, just a couple minutes in defense of policy activism. Since we got it anyway, we might as well understand what's happening and ask ourselves whether it makes sense or not, and whether we should fear it or not. I remember GDP growth. Cycles are not we're used to cycles. This is probably the 44th one we've been in since the 1850s. This picture showing you GDP growth, and you'll notice, by the way, just to prove that I mark to market, I do have the most recent recession in here, but the NBER yesterday told us we actually began. And even though I kind of object to the concept, I think it's an overly simple label to how to describe what's going on right now. But I remember Richard Nixon told us, when Richard Nixon in 1970, I think he had a fiscal stimulus package, when he said we're all Keynesians now, what he was referring to was we've learned over time when the economy gets into trouble to be aggressive with the use of fiscal policy. And the question is, does that make sense or not? Does it make sense to do this? Now, you'll notice this is the level of GDP, and my construct of the potential level of GDP, which is in the background, it's debatable. It's the yellow zone. You'll notice that when you look at how we have managed the economy over the years, you can't see much difference between Republicans and Democrats anymore in terms of managing the economy when you've got a problem. We all tend to be activists. Bill Clinton, you could argue, was not, but he lucked out because the peace dividend allowed us to bring down the level of defense spending, and he was able to bring spending down without really inflicting much pain. And as a result, we got a surplus over the course of the years. But if you've been paying attention to what happened in President Bush's administration, the combined fiscal actions of the administration between the 2001 tax cut agreement and not vetoing spending bills over the next several rounds, plus the various stimulus packages, he put in place a fairly aggressive stimulus package. The question is, and you know what's coming. You know that in the months ahead, in the weeks ahead, if Richard Nixon said that we're now all Keynesians, you're about to watch the first string put in place fiscal policy, and you're going to be watching fiscal shock and awe as we try to get things turned around in the economy. And the fiscal packages are probably going to be very large. I would not be surprised if President-elect Obama has on his desk a bill, $500 to $700 billion fiscal stimulus to sign. And the question is this dangerous? Is this a trouble or not? And what I want to argue, we economists have gone back. We go back and forth on this. We know the economy goes through cycles. What we generally agree on is if demand is the problem, if it's aggregate demand that's the problem, it makes a lot of sense for the government to come in and stimulate the economy and try to get the real economy back to full employment. If it's a supply shock, as the real business cycle view holds, and that is the driver of the cycle, it doesn't make sense to use fiscal policy. You have to let the economy work its way toward where the potential level of activity is. But I think in the current circumstances, we all generally agree with the housing crisis the way it is, with the consumer sector likely in a secular transition to a more moderate era of growth. It probably makes sense to think of what we're in the middle of right now as a demand shock. And so what you're seeing play out on the policy front is probably appropriate, and it's the reason why Ben Bernanke tends to endorse actions by Congress to do something here. The danger is if we're not careful and we put in place a lot of programs that cannot be unwound. That's the danger. And I'm not referring to the TARP program or a lot of the programs that are motivated toward getting the financial market unfrozen. I'm thinking more about spending projects or putting in place projects that are difficult to unwind. That can be the issue. Now, in terms of the in terms of the economy, here's the way. This is a slight oversimplification of the story, but here's my thinking about 2009, and I think this is behind comments that Charlie made to you. It's that we economists tend to believe that the most likely course for 2009 is it's going to be a difficult couple quarters, but as we go into the summer, second half of the year, we should be expecting a rebound in the economy. And then there's a couple things on my mind that make me relatively comfortable with this idea, let alone forget what's going on on the policy side. First of all, to me, there's nothing wrong with the U.S. economy that hasn't been fixed already. And there's really just one problem that we faced, and it really kind of emerged after Labor Day. And what I mean by that is the excesses in the housing industry have largely been cleaned up. Doesn't mean that we're done with this, but they're largely cleaned up. To me, the oil convulsion was the #1 problem, not just for the U.S., but the entire world economy. As you know, that's behind us. And the real danger right now, I think, is when the bottom fell out of the market in September. We all know what happened. If you care to open up your statements from your favorite mutual fund, and I would advise against it, you know what's happening. And so the danger is that the shock that took place this fall has got everybody cautious. You can smell it and hear it all around the business community. It's made everybody pull back. And of course, fear can become self-fulfilling, and that's what we're seeing play out over the next couple quarters. And that's why I think most of us have moved to the idea that the economy is going to be contracting for the next couple quarters before we see a rebound. But here's what I mean, and this is sort of an illustration of, puts numbers on my own forecast for how to think about next year. Not a great first half of the year, but an economy that rebounds, GDP growth, quarter-on-quarter basis. And eventually, as we always see, when you come out of these difficult periods, you grow at an above-trend pace. That's how unemployment comes back down. That is the goal of the policymaking community. Now, when I say there's nothing really wrong with the U.S. economy that hasn't been fixed, what I mean by that is housing and energy in particular. The housing market, ground zero is really what happened back home, primarily back in California, Las Vegas, Phoenix, Florida, where we all know the house prices got out of whack. The house prices got inflated. It's not clear what caused what, but clearly the credit system, there was a lot of bad loans underwritten, and it enabled a speculative boom in much of the other parts of the country. And I think the best way to sort of try to put a face on this and try to get a sense of what happened is what I'm trying to show you on this picture, which is look at house prices relative to underlying family income, to give you sort of a benchmark of when are we out of sync and when are we not out of sync. And what it shows you is the evolution over time since 1970 on the left hand of the picture, with the shaded area is income. The black line is the Case-Shiller index of house prices. And what I'm showing you is everything is a ratio to 1970. So we're watching the evolution of house prices and family income over time. And the idea here is incomes tend to be, you think of it as sort of it's the most important thing that anchors affordability. It's kind of trying to give you an idea of where our prices relative to what we can afford. And what it shows you is house prices tended to track incomes over time till the early 1990s. The reason house prices tended to lag in much of the 1990s was because when the Berlin Wall went down and the Soviet Union evaporated, the peace dividend allowed us to bring down defense spending. And it had a particularly big impact on the defense belt, which was the East Coast and California, hot real estate markets that struggled for much of the 1990s. And then we had what happened this decade. House prices, as the picture shows you, house prices rose 85% from 2000 to 2006. Incomes rose only 25%. In other words, house prices rose 3 times as fast as your income. The only way you could afford a house in that environment was if you got your hands on some kind of affordability product, like a subprime interest-only loan, which allowed you to qualify for a loan based on the interest payment only, not the full mortgage and interest and principal payment. And we all knew a couple years ago that something had gotten out of sync. But the thinking at the time was, well, you know what? Maybe the way we're going to work out of this is that prices will level out and we'll kind of grow into those valuations. What happened was completely unexpected. What happened was very unprecedented, and it's the heart of the reason why it is that Wall Street is tied up in knots. Prices came down very dramatically. Now, when I hear people say, we need to do something to stop the decline in house prices, my question is, why do we need to do that? If house prices were inflated and got out of line, why should we try to stop a correction that we need to get this problem behind us? And the truth is, that's what's been going on. I don't think any of us economists thought we would see such a rapid correction in house prices. And secondly, I don't think many people thought we would see the keys turned back to the lenders in the numbers that are coming back to the lenders. And so if you connect the dots between what is happening on Wall Street, where financial industry has written down $1 trillion of losses on their portfolios, and what's going on Main Street, the reason that's happening on Wall Street is because folks out there were speculating. And my guess is when we get all the numbers and we understand better this event, we're going to discover, as the builders are now fessing up, that there was far more speculation out there than people were admitting at the time. And that's what's behind this rapid correction going on here. You and I live in our houses. We send our kids to school. We got friends in our in the neighborhood. If our prices go down, we don't walk away from that mortgage just because we're underwater. We've got a commitment to our community. The only reason we would do that is if we've got no skin in the game and we're speculating. And I think that's a very big part of what's happening that is behind this problem. And this is why, by the way, it's very difficult for Wall Street to value the assets they have and even the synthetic products, because if you don't know yet what the outlook for the default performance is going to be, very difficult to value these assets. You don't know that until you understand when this correction in the housing market is going to be over. And that's why, as an economist, I say the one single thing that I would like to know about the future, if I'm only allowed to know one thing to help me figure out what's going to happen, I want to know when the correction in house prices is going to be over, because when it is, you will see the lights coming back on Wall Street, and it'll be much easier to figure out how to value these assets, and we will get this thing behind us quickly. Personally, I think the picture, as you can tell, the way this picture illustrates it, I think it's very hard to argue that U.S. housing market's inflated anymore. And I think personally we are in the neighborhood of where we need to be, because house prices relative to incomes are about where they tend to be, give or take. So it doesn't mean that home prices are going to stop falling, but I think it's easy for me to believe that we may be near the end. So when I hear people say, no, we're only halfway through, or we got another 10, 15% house price correction to go, I think to myself, if that happened, even I would own a second home. Because I think if that happened, house prices in the U.S. would be as cheap as they've ever been relative to our ability to afford. Now, second issue, why I say there's nothing wrong that hasn't been fixed. If you remember, and personally I think this is the elephant in the room, and there's a debate about this. Is it the financial system that's causing the problem? Is it the convulsion that happened in the oil market? What I'm showing you here is oil prices, the line, and the blue zoning in the back is the global demand for oil. We know oil demand is going up. We know what the future looks like. 8 times as many people live in China and India as live in the U.S., and yet they consume half the energy. Doesn't take a lot of imagination to figure out what the future looks like for energy demand. The problem is, why today? This is going to take 3, 4, 5 decades for it to play out. The reason we in the financial markets are able to act on that idea is because commodity index funds allow us to allocate a portion of our portfolios to commodities. And it's very hard. No one really knows the answer here, but I'll bet most of us are not going to quarrel with the idea that what happened in the past year was a speculative thing that happened in the oil markets, because what changed after August 2007? What happened that made us think the future is getting hungrier for oil? The U.S. economy was going through a credit crunch. The global economy looked like it was slowing down. And yet what happened over the past year, oil prices doubled. Now, what's interesting about, here's the issue. There's nothing wrong with oil prices going up. The problem is we all use oil. It's very inelastic demand. And the problem is when there's something important that we all use and you have a sudden shift in the prices, it's no different than bananas, except the problem is that for the moment that it happens, it's a very massive transfer of resources from one region to another region. When oil prices went from $70 a barrel in the summer 2007 to $140 this last summer, what that meant was a couple $1 trillion in the blink of an eye was getting shifted out of the oil-consuming region into the oil-producing region. And the problem with that is, give it time, there's no problem. But the problem is, initially, it's very hard for those who are benefiting to spend the money as quickly as we can't spend the money. So for all those folks who live in regions where they consume more oil than they produce, and that includes India and China and Korea and Japan and the United States and Europe and much of Latin America, what happened was a very big shock to the system. Now, you know, in the short run, this picture here is showing you what you would expect the impact of such a jolt to be on the U.S. economy, and it applies to anybody else who's in a situation like the U.S., including Europe and Japan. What would you expect to happen if oil prices doubled over the past year? Well, you'd expect growth to slow down 1 or 2 percentage points. And that's why, if you look at what happened globally, isn't it interesting that while we all here were very focused on the housing crisis, we all thought this was a U.S. issue, a credit market issue. The fact is, all around us, everybody is feeling it. And they're all doing it the same way. Japan, Europe, U.S., the developing world, everybody is slowing down. And this has been going on for a little while. This didn't just happen now. This has been going on really since last winter, about the time we were here. You were here last year. What that tells you is there's something common that affected everybody. What's that common thing? The easiest thing to think of is the convulsion in the oil market. But the reason I say there's nothing wrong that hasn't been fixed is because, as you know, these prices have come down. This big headwind is now turned into a tailwind. And so as we look into 2009, we ought to expect that what was a very big drag in the past year is all those resources were shifting out. It's now shifted back. And it affects us every day we go to the pump. It affects everybody, whether you're in Tokyo or Beijing or Mumbai or Europe. It's affecting everybody. So I think it's very easy to look at what's going on, and we think we're all distracted by what's going on Wall Street, thinking that this is the real issue, and it is an issue. But the truth is, I think there's something more pervasive that's been affecting everybody. Number three, the third thing we're dealing with now, and this is a real threat, and it's a psychological threat. As you know, after Labor Day, things like, it seemed to us, for much of the year, we in the equity markets had the belief that the housing credit crunch was a Wall Street thing, and that the Fed, through its actions and actions by the Treasury, could immunize the broad economy from what was going on Wall Street and the housing industry. In fact, we've never seen, outside of the 1930s, we've never seen a financial crisis take the U.S. economy down. And so there was a belief for the longest time that this was a manageable problem. And in fact, the hit to the building business was being offset by strength in the export businesses, oil and gas businesses, agriculture businesses. There was no reason to think that this was going to take us down. And yet, what happened after Labor Day, I think, changed the story. And all of us economists buckled in response to the decline when the bottom fell out of the stock market. All of a sudden, everybody paid attention. And suddenly what looked like a Wall Street problem was now everybody's problem. And you can hear this in the business community. When the stock market drops 20, 25% like this, it makes everybody cautious. And the truth is that caution is what's you can see it in the numbers. Everybody's pulling back. And I think that's kind of the challenge we're dealing with right now, which is why we economists expect for the next couple quarters we're going to be facing a difficult time with the economy contracting probably 3 or 4% for the next couple quarters. Now, there's a couple things I hear, worries. For those who are deeply pessimistic, there is a fear that we haven't seen all the shoes dropping. And there's two fears in particular that you hear mentioned. One is that you've always been told that people were living on the equity in their houses, and this is, with the equity disappearing, what's going to happen to consumer spending. And the other thing you hear is, just as the financial system has gotten very leveraged and is now deleveraging, we're going to have to watch the same thing play out for the household sector, because we all know the household sector is full of debt, and don't we have another shoe to fall for the household sector? And what I want to argue here in the next couple minutes is I don't think so. And I'll tell you why. You sort of get this in terms of people were treating their houses as an ATM. That story sounded very interesting, and I'm sure you know friends who were doing this. I think if you were in California, you probably would have many more examples of people who were taking equity out of their houses and living on it. The truth is, this story does not square with a macroeconomist perspective, and here's why. This picture is showing you consumer spending trends and income trends over 5-year increments. And if it were true in this decade that folks were taking equity out of their houses and living on their equity in their houses, you would expect to see consumer spending living on that wealth consumer spending would be growing much faster than income. In fact, this is not what happened in this decade. That story was last decade's story. When the stock market was booming, saving was coming down, everybody was spending faster than income. This did not happen in this decade. Consumer spending, as the last 2 bars show you, in this decade had been growing about in line with income, which tells you there's a reason why consumer spending was doing well. The economy was recovering, job growth was positive, income was growing. So I think for those who fear that the decline in house prices is draining spendable income for households, I think that story was somewhat exaggerated. And I think it's one reason, by the way, despite the big collapse, 22% decline in house prices in the U.S., we have not seen a collapse in consumer spending. We've seen a slowdown in consumer spending as we lost the support from those rebate programs, but not in the consumer area. Second issue, leverage. I think this is a very confused story. The shaded area here is showing you household debt in relation to income. The scale's on the right-hand side. I'm breaking household debt into 2 components here. Consumer credit on the bottom as a ratio to income, and the top part is mortgage credit. And folks look at this and they say, look, our generation today holds twice as much debt as my parents' generation did. And this all happened starting around the mid-1980s to the present. We know what happened. Well, if anybody here bought a house in the 1980s, you kind of know the story. And it's not very complicated. When I bought my first house in Washington, a $100,000 loan at 14% interest was basically a $1,400 payment. Actually, I had a smaller loan than that. $1,400 payment. When rates came down to 5% or so where they are today, that allows me, for the same monthly payment, to take on a mortgage obligation of $265,000. In other words, with interest rates where they are, I can carry 2.7 times the amount of debt I could when I bought my first house in 1979. What happened here, as you can tell from the picture, as mortgage rates came down with the Fed's success in bringing inflation down, which my generation never ever dreamed was going to happen back in the 1970s, when inflation came down, it brought mortgage rates down from the 14 to 17% range down to where they are today, 5-6%. And as that happened, people did the rational thing. They realized they could take on more of a mortgage obligation without raising their monthly payment. And that's why we saw most of the rise in leverage in the household sector occurred in the mortgage area, not in the consumer area. In the mortgage area, where you are constrained from taking on more debt. So the question is, going forward into next year, every reason to believe with these hurdles behind us, the housing excess is getting corrected, oil prices getting corrected, and fiscal policy on the aggressive side and Fed policy very stimulative as well. There's every reason to believe that when we're here next year, the economy ought to be, the arrows are all going to be pointing up. I'm almost certain of that. That's the reasonable expectation. The question is, what kind of recovery should we expect? I think there's plenty of reason to believe that what we're going to be dealing with for a while is probably a slower kind of recovery than we're used to, because there's a couple big structural things that we're dealing with right now. Number one, and I won't show the pictures for this, but number one is the financial system, as you know, had gotten very leveraged. If you're an investment bank, you're leveraged up 30 to 1 basically, whereas we in the commercial banking community have leverage of maybe 12 to 1. And what we are watching play out, and we knew this back in August of 2007, I think the market instinctively knew that what was coming was going to be an era where the financial system was going to have to deleverage, and all those assets that had been taken off bank balance sheets, parked into near bank vehicles, the shadow banking community, a lot of those are going to have to come back to the bank balance sheets. And in that case, what that means is the years ahead of us, the next several years, are going to be a period where credit is going to be more expensive, more difficult to get. It won't be as easy as you and I have known for the last 10 years or so. And that suggests that Fed policy may need to be more accommodative than usual in order to work through this problem. The second thing to think about is what's going on in the consumer sector, and this is not a new story. This has been going on for a couple of years, and I can hear it with all of my clients who are in the high end, and I always figured this would be where I would hear it. You and I have watched for the past 2 decades a consumer era that was really quite remarkable, and you see it reflected in 2 places. Number one, here in this picture, if you look at the ratio of consumer spending to GDP, what it shows you is consumer spending was about 60% of the economy back until the mid-1980s, and then over the last 2 decades, consumer spending has been rising to about 70%. This is a very unprecedented thing. It was the result of remarkable thing that happened, and it's reflected in household behavior. What you saw over the years, over these last 2 years, 2 decades, as equity values rose, and the value of household net worth rose to record levels. It doesn't feel like that today, for sure, but what happened, if you look at this chart, household net worth rose to record levels until what happened this year, and as that was happening, households felt, because they were making gains on their financial assets, they didn't need to save. And if I don't need to save, it means I can spend more. Well, that story really has come to an end. It came to an end really at the beginning of the decade. And what we've been seeing, household net worth has no longer been rising like it was. And what it means is that this era over the past 2 decades where consumer spending was able to grow faster than income, saving come down, that era is behind us. And it means that the U.S. consumer is in the middle of a transition to something more like what our parents knew, where we start saving the old-fashioned way. You and I are going to discover that in order to make progress financially, we got to set money aside from our income. And what that means is the consumer sector is not going to be the consumer sector you've known. It's not going to be the consumer sector that is driving the Asian export businesses. That whole business model out there has been based on the idea that the U.S. consumer, we go to the mall when we're happy, we go to the mall when we're sad, we just always go to the mall. Well, that story is yesterday's story. It's not going to be tomorrow's story. And that's why I say when you think about the recovery that we're coming into, it's probably going to be slowed by this transition that's been going on of a U.S. consumer sector that's in transition. I agree with Charlie on the inflation. It's an important story in my mind. I think what's important is this picture exaggerates the story, really. This is the market's inflation expectations for the next 10 years. To me, this is the positive story that's coming out of the current turmoil. And that is that inflation, there was a lot of fear about it over the past year with oil prices exploding, but things have changed and the market has now shifted from worrying about inflation to worrying about deflation. I agree with Charlie, deflation is the wrong story. Unwinding speculative excesses, bringing oil down and all these other things is not a deflation story. A deflation story is a story about an economy that's underperforming, chronic shortage of demand, 1930s. I don't think that's what we face. But when you look at the market's view about inflation, which is reflected in the tip spread here, this picture is exaggerating the picture a little because we have to incorporate an understanding that oil prices are going to be coming down. So in the near term, we know headline inflation is going to be down. But it's an important change in the thinking. It's why Charlie says inflation expectations are anchored. That's key for the Fed, and it's an important concept. And one of the reasons why the market is comfortable that a lot of what you're seeing play out, even on the policy side, is not going to be inflationary is because with unemployment going up and likely to go up higher, It's very possible. Nobody really knows where it's going to go. My guess is 7 or 8% is probably the right idea, because it takes a while to get the economy to turn around. With that picture in front of us, it's not hard to be comfortable that the inflation story is behind us, and this is, to me, represents the final stake in the heart of inflation that the Fed has been working since Paul Volcker to try to bring down. It's an important story, and to me, this sets the stage for the next expansion, and it's the kind of thing that you hope for. If inflation's not a problem and you get through your problems, it means you can expect a solid, sustained, balanced expansion in the period ahead. So when fear rules, I'll just tell you what I told my son, and actually people who have more credibility said the same thing. My son asked me when the stock market was going down, back in September, he said, should I be buying stocks? And I said, in my memory, in my life, there have been 3 times that proved to be good times to buy stocks, to get engaged in the market. They happened to be the mid-1970s. Richard Nixon was resigning. We were about to embark on a deregulation of a whole bunch of industries. Paul Volcker coming to the Fed, slam on the brakes. Interest rates were sky high. 2002, the stock market had plunged 50%, just like today. Our IRA and 401k plans had disappeared, just like today. And this was all in reaction to a fear that American businesses were cooking the books, WorldCom and the corporate earnings problems. And I said the common thread in those 3 moments, in retrospect, it was a perfect time to be engaged in the market. The common thread in all of that is that fear ruled. People overreact just like we do on the other side. And when fear rules, those are times when you're supposed to get interested in convince yourself that there is a future. And you see that when I'm looking at the price-earnings ratio of the stock market, there's the yellow zoning here. It's at the cheapest levels since the post-World War II level. And that's why that's what the stock price is down here. It tells me, should we really be pricing assets at the cheapest level in the post-World War period? I don't think so. Not with inflation down, not with excesses in the U.S. economy having worked out, not with the world around us waking up and the lights coming on. The future has a lot of possibility in it, and there's an awful lot of earnings, and there's a lot of good assets out there. And I think in time we will look back at this period the way I was thinking about the 3 moments in my lifetime. My words didn't mean anything to my son until he heard Warren Buffett say, "I'm greedy when others are fearful." That's the right idea. Thank you.
The question was, I talked about transparency, in particular you raised the question about credit default swaps. Is there more transparency today than there was 6 months ago? I think the answer to that is yes, but not completely, because the problem still remains in part, Jim talked about this, and that is that the credit spreads we see in the marketplace and some of the risks that market participants are avoiding are still because they don't know who's exposed to these various instruments. They don't know what those instruments are going to be worth, and they don't know where they all are. And it's taking much longer than any of us would like for the market, I call it price discovery process, to unfold. I think in the future, one of the things we're likely to see is more mechanisms for transparency. One of the things that the Fed has been pushing very strongly for is for not so much regulation, but to open a clearinghouse mechanism where a lot of these over-the-counter derivatives can in fact be traded, and have a clearinghouse where the products become more standardized, where there is more transparency about who holds what, and it'll be easier for the market. So I think we're making some progress, but it's very slow. And I suspect there'll be some products. I mean, financial markets, just like any other industry, we have innovation. And innovation throughout the industrial part of the economy. People dream up new products. You know, you put them out in the market, and some of them work and some of them don't. Well, we've had a lot of innovation in the financial markets, and a lot of stuff's been thrown up against the wall. Some of it works, some of it doesn't work. And those that don't work will either go away Some of them will be restructured, or the contracts will be rewritten, or they'll look different, but somebody will try to make a market for them. And that's the way the innovative process works. But this one's been particularly traumatic because there are a lot of products that a lot of people didn't understand. So I think we'll get more of it, but I don't think we're there yet.
You know, where the Fed has become very transparent, that's probably the most important side of this. It's real clear to everybody in Wall Street now and to the public what the Fed's long-run inflation goal is. And the Fed and the public embraces that. And I think that's probably the most important. We understand clearly what the objective was. And the rest of it, we're as in the dark as the Fed is when it comes to trying to understand what's going on.
Other question.
My feeling always has been that there's a black hole sitting over Detroit, and the closer you are to that, the bigger, the more the trouble. But the truth is, things have been actually doing a little better here recently, and around even Western Michigan to this area. If you're not really tied to the auto industry, it's been okay. I think the big problem now, and everybody was becoming more optimistic about prospects for the region. The problem is that now with Wall Street in a major shutdown mode, and it's going to be very difficult. We're going to have to reinvent the whole system over the next 5 or 10 years. It's going to drain a lot of revenue from the state's budgets. So my guess is this is a time you're sort of caught between two black holes now. And I don't know, you're struggling. You're struggling with. You've been struggling with the turmoil in the auto industry and what's been going on, it's hitting Michigan pretty hard. But I always thought it wouldn't be long before you felt that you were starting to swim against the tide because the dollar had come down from very high levels. We're starting to see a boom in our export businesses. Anybody in this whole area sort of has exports are a bigger share of our economy than in other states. But now you're stuck with another, shock that's hitting the financial sector. So, and a national economy that's struggling even more. So, I think you got to be cautious and defensive. When the economy goes through a downswing, every industry goes through this, and it's not surprising that state and local communities are struggling. As you could see from the story this morning, California's got the biggest problems. Part of the problem is the states that were not careful in building war chests when in good times find themselves in trouble now. And so whenever we go down, everybody struggles. And the truth is, when car sales are 10.5 million or 11 million, nothing makes sense. GM's problems today remind me of something Southwest Airlines CEO, when oil prices were 147 this summer, he said, when oil prices are here, our business makes no sense. When car sales are 10.5 million, car business makes no sense because that whole infrastructure is based on a thriving, fully employed economy. And that's our problem when the state and local communities is that when the economy is not at full employment, and it isn't, everything everything struggles, revenues are down, and the states that have a heavy concentration in the financial industry are going to feel this too. The only thing I'll say about this is I think the plans taking shape in Washington, at least the chatter that you hear about the fiscal packages, almost always include some kind of relief for municipalities, state and local municipalities, extending unemployment benefits. So my guess is the package that takes shape that President-elect Obama will be signing, I'm assuming he'll have it on his desk by the time he gets in the office, will probably include money for this.
I think that's right. But with regard to the Fed, if there is a fiscal policy, which would be, as Jim is alluding to, a package that would include some relief for state, local, and municipal governments, seems very likely. It also seems very likely that that money would not be coming from the Fed, because legally the Fed cannot lend money to governments. There's no provision in the law for us to do that. So even if someone were to come, and believe me, there have been requests. I even got in line, thought I could get some money, but I say, So that channel seems highly unlikely. Although I have to confess, in the last year, never say never, you know. but legally the Fed does not have the authority under current law to lend to municipalities.
These are certainly challenging times the last few months, and with that in perspective, when you compare, let's say, where we were with the market last October, got a call about 2 months ago from an alum from the early 70s who went on to start MySpace. And what was reassuring about the call was he said, you know, these times strike me very similar to when I graduated. The Dow was down. We had challenges, worries about what would happen with inflation, with oil prices, with unemployment. But what it did is it created an opportunity for him to identify his passion, which was ultimately to be an entrepreneur. And even though he struggled mightily, this is a person who in April of this year took in 1 week 4 different companies public because he's found that that's what he really likes to do. And just from a personal perspective, one of the most wonderful things about the job is I tend to be very bullish on the future. When you interact with alums, half of whom from the Simon School 10 years out are entrepreneurs, or to see the passions that are germinating on campus. We have a number of current students with us today as they seek to explore how they're going to add value in their careers. We're very grateful to Jim and Charlie for being our speakers, to the RBA, to JP Morgan Chase for being our co-sponsors, to all of you for joining us. If there are any ways we could help your organizations add value, especially through our students and their fresh ideas, fresh blood, let us know. We will be delighted to make the connection, or through our education programs. If you saw in the RBJ on Friday just the return on investment, while people have questioned the return on the Dow, you look at something like the EMBA program, it has a pretty significant, at least what companies are willing to pay for graduates going through that program. And we find similar phenomenon with the full-time and part-time. Wish you a happy holidays, a healthy and prosperous new year. Thank you for joining us today.